great pleasure to be here and to be introduced by my good friend Adam Posen, who we had just a wonderful collaboration when actually he showed up at the Federal Reserve Bank in New York exactly at the same time that I did, and was somebody who really stimulated my thinking. We also had just a wonderful time working on the project. To give you an idea of why he's the deputy director here, I got up in front of the staff and said, you know, I want to start this project on inflation targeting, and said, I'm going to start this project, and if anybody's interested, please get in touch with me. And Adam is the first. Adam comes to see me, I think, within 20 minutes and says, I said, giddy up, you're in. And that's the kind of pursuit and aggressiveness in the best sense of the word. I'm a New Yorker, so aggressiveness is considered fun, but you don't want to kill somebody trying to knock down a little lady. It's to actually get some important things done. And we've actually had an interaction ever since, and I think it's a great credit to this institution. And it is amazing to me to see people growing up. And when I still feel like I'm only 25, I can't figure out what happened for all these other people who have been in this position. So what I'd like to talk about today is Whither Federal Reserve communication, and I did not put it in a question mark. Over the years, the Federal Reserve has significantly increased the transparency of monetary policy making. For example, starting in 1979, the Federal Open Market Committee has included the economic projections of the FOMC participants in each semi-annual monetary report to the Congress. Since 1994, the FOMC has publicly announced changes in its target for its policy instrument, the federal funds rate. Most recently, the FOMC extended the horizon for its projections in October 2007, and is now publishing its projections 4 times a year. Has the Federal Reserve gone far enough? Or would further advances in transparency be useful? I will argue here that the science of monetary policy suggests that the Federal Reserve can indeed go further in enhancing its communication strategy, and that doing so would produce important benefits in economic performance and democratic accountability. I will also outline a specific proposal of my own and address a few concerns that some might have with elements of this proposal. Before proceeding, I would like to emphasize that my remarks today reflect only my own views and not necessarily those of anyone else on the board of directors of the FOMC. Now, that's the usual one, but indeed this disclaimer has even more meaning now, since as many of you know, I will be leaving the Federal Reserve at the end of August and returning to Columbia University. It's good to be a professor. So let me now talk about what are the key, and if you know what I'm referring to in terms of a Mel Brooks movie, you'll understand what I mean. So first let me talk about what are the key scientific principles for monetary policy communication. To think about what kind of central bank communication is desirable, I will begin by considering some key scientific principles regarding the benefits of central bank transparency. I also discuss scientific principles regarding the objectives of monetary policy in the written version of this speech that is posted on the website. But I don't have time to go into that here. And in fact, there's also some pictures and very clean ones. They're just graphs with some data in them. But I decided that it would be much more difficult to do that here. So if you're interested, you can look at the longer version there. So let me first talk about the benefits of central bank communication. A central element in successful monetary policy is the establishment of a nominal anchor. Why is this so important? The expectations for inflation of households and firms are a key factor in determining the actual behavior of inflation. In the absence of a firm nominal anchor, these expectations may wander if the private sector revises its assessment of the rate at which inflation is likely to settle. And these movements and expectations for future inflation can generate pressure on the current inflation rate. By establishing a transparent and credible commitment to a specific numerical inflation objective, monetary policy can provide a firm anchor for long-run inflation expectations, thereby contributing to the objective of low and stable inflation. Additionally, the presence of a firm nominal anchor gives the central bank greater flexibility to respond decisively to adverse demand shocks. Such a commitment helps ensure that an aggressive policy easing is not misinterpreted as signaling a shift in the central bank's inflation objective, and thereby minimizes the possibility that inflation expectations could move upward and lead to a rise in actual inflation. A strong nominal anchor can be especially valuable in periods of financial market stress, as we, of course, been experiencing recently. And this is true because when prompt and decisive policy action may be required to minimize the risk of a severe contraction in economic activity that could exacerbate uncertainty and financial market stress. Thus, the establishment of an explicit numerical inflation objective can play an important role in promoting financial stability as well as stability of employment and inflation. More broadly, it should be noted that central bank transparency contributes importantly to democratic accountability and economic prosperity. In particular, in a democratic society, the central bank has a responsibility to provide the public and its elected representatives with a full and compelling rationale for monetary policy decisions. Clarification of the central bank's objectives and policy strategies also reduces economic and financial uncertainty, and thereby facilitates efficient decision-making by households, businesses, and financial market participants. So first, let me look at this issue of how has Federal Reserve communication been enhanced. The Federal Reserve has been a pioneer in a number of aspects of central bank communication, many of which I've mentioned at the beginning of these remarks. In a previous speech, I outlined the enhancements to the FOMC's communication strategy that were announced in November. Most importantly, the forecast horizon for the FOMC's economic projections now covers 3 calendar years instead of only 2 years, and the committee now publishes these projections 4 times a year rather than 2 times a year. As I indicated last November, I believe that these enhancements provide important information that will contribute to the public's understanding of our objectives and the rationale for our policy actions, and hence will facilitate the decision-making of households and businesses. As reported last week in conjunction with the minutes of the latest FOMC meeting, the projections for overall PC inflation at a 3-year horizon, which is currently 2010, fell in a range of 1.6% to 2.1%. And the central tendency of these projections was 1.8% to 2.0%. Each FOMC's projection is made with the assumption of appropriate monetary policy. That is, the path of policy calibrated to achieve outcomes for economic activity and inflation that are, in the eyes of each participant, most consistent with the objectives of price stability and maximum employment. For that reason, the longer-run inflation projections provide information about each FOMC participant's assessment of the long-run inflation rate that best promotes these dual objectives. And this is what I refer to as the mandate-consistent inflation rate. The increased information that these projections convey regarding FOMC participants' views of the mandate-consistent inflation rate, combined with the FOMC's continuing commitment to keeping inflation low and stable, should help anchor inflation expectations and actual inflation more firmly. The longer-run projections of output growth and unemployment are heavily influenced by FOMC participants' assessments of the sustainable rates of output growth and employment. As a result, these projections can provide the public with useful information regarding the FOMC's estimates of the sustainable rate of output growth, often referred to as potential GDP growth, and of the sustainable unemployment rate, often referred to as the natural rate of unemployment. Providing projections for the short run as well as for the longer run encourages FOMC participants to think in terms of desirable paths for inflation output, a discipline that economic research suggests will produce better policy outcomes. These projections also are useful in enabling the FOMC to explain its policy decisions and strategies more fully in the context of its medium-term objectives for economic activity and inflation, as well as the risks to those objectives. As a result, the public and the Congress can better assess whether our forecasts of the economy are reasonable and whether we are pursuing a policy that's consistent with achieving the dual mandate of price stability and maximum sustainable employment. The result should be increased accountability that is consistent with basic democratic principles. So now let me talk about the issue, is there room for improvement? And obviously you're going to think that the answer is yes, I wouldn't be here today. Although the enhancements to the FOMC's communication strategy last November have been a major step forward, I believe there is some room for further improvement. So let me first of all talk about conceptual considerations. As a conceptual matter, the 3-year horizon of the projections may not be long enough to provide sufficient clarity about the views of FOMC participants regarding the mandate-consistent inflation rate, the sustainable growth rate of output, or the natural rate of unemployment. Moreover, these projections do not establish a transparent and credible commitment to a specific numerical inflation objective, and hence do not provide a sufficiently firm nominal anchor. In my view, the length of the forecast horizon is particularly relevant at the current juncture in considering the projections for output growth and unemployment. Because of the recent adverse shocks to the economy, including turmoil in financial markets and the sharp increase in the price of oil, output growth in recent quarters has fallen below potential, and the unemployment rate is, as best as I can judge, above the natural rate. Similarly, sharp increases in the prices of many commodities have driven inflation above rates consistent with price stability. Even under appropriate monetary policy, committee forecasts inflation, output growth, and unemployment might not settle at the respective long-run rates within the 3-year horizon, obscuring committee participants' views about these key parameters. This problem may currently be somewhat less acute for the current state of inflation projections, because inflation is projected to moderate to about 2% or below by the end of the projection period. Nevertheless, to the extent that some slack in economic activity is projected to persist through 2010, that slack might well produce a modest further decline in inflation, implying that policymakers' projections for inflation in 2010 might be a bit higher than their assessments of the mandate-consistent inflation rate. So now let me talk about empirical evidence. My discussion of room for improvement relative to the Federal Reserve's current communication strategy has been theoretical. There is, fortunately, evidence from a number of countries that have adopted an explicit numerical inflation objective, including Canada, New Zealand, Sweden, and the United Kingdom. And there's also evidence from the experience of the European Central Bank, which has not adopted an explicit numerical goal, but has provided a fairly precise verbal description of its commitment to keeping inflation under control by saying it should be below, but close to 2% in the medium term. Over the past several years, empirical work that has drawn on this international experience has found some significant benefits in anchoring inflation expectations by establishing an explicit inflation objective. For example, there is substantially greater disagreement in long-run inflation forecasts for the United States than for the euro area. The standard deviation of U.S. inflation forecasts at each survey date is higher than the standard deviation of corresponding euro area inflation forecasts. So these are the kind of figures that you're not going to see, that you can see on the website. Moreover, the degree of dispersion in the views of individual forecasters has gradually declined toward negligible levels for the euro area, but not for the United States. One obvious interpretation of these patterns is that professional forecasters in the United States are less certain about the Federal Reserve's longer-term inflation goal. That uncertainty may also explain differences in the behavior of inflation compensation as implied by the gap between nominal and real yields on long-term bonds. Far-forward inflation compensation for the euro area displays much smaller fluctuations than for the United States, consistent with a greater stability of inflation expectations and a lower degree of uncertainty about longer-run inflation outcomes. Moreover, regression analysis confirms that U.S. far-ahead forward inflation compensation exhibits statistically significant responses to surprises in macroeconomic data releases. And that's consistent with the view that market participants are continuously revising their views about the long-run outlook for U.S. inflation. In contrast, euro area inflation compensation does not respond significantly to economic news. One concern might be that these benefits in anchoring inflation expectations could come at the expense of the performance of output growth. However, the international experience indicates that an explicit inflation goal does not imply that central banks place more emphasis on stabilizing inflation to the detriment of stabilizing output. The empirical evidence also finds that central banks with explicit inflation goals do not have worse output performances than central banks, such as the Federal Reserve, that have not specified an explicit numerical goal for inflation. This overview of the evidence should not be viewed as suggesting that the steps the FOMC has taken to improve its communications over the past couple of decades, or the more recent enhancement last fall, have provided no benefits. Rather, this analysis supports the view that some room for further improvement still remains. So now I want to talk what should be done, and I'm going to outline a proposal for where I think we should head. So this is maybe why I didn't put the question mark now. So in light of these considerations, I would like to suggest several specific modifications of the Federal Reserve's current communication strategy. First, the horizon for the projections in output growth, unemployment, and inflation should be lengthened. This change might involve simply an announcement of FOMC participants' assessment of where inflation, output growth, and unemployment would converge under appropriate monetary policy in the long run. Alternatively, the horizon for the projections could be extended out further, say, to 5 or more years. Second, FOMC participants should work towards reaching a consensus on the specific numerical value of the mandate consistent inflation rate. And this consensus value should be reflected in their longer-run projections for inflation. Third, the FOMC should emphasize its intention that this consensus view of the mandate-consistent inflation rate would only be modified for sound economic reasons, such as substantial improvements in the measurement of inflation or marked changes in the structure of the economy. So would this proposal work? It is reasonable to ask a few questions about whether these proposed changes would be feasible or desirable adjustments to the Federal Reserve's communication strategy. So I want to deal with a whole set of questions that are concerns that people have been raised by the kind of approach that I'm outlining here. So the first, and really the most important, is would this proposal be consistent with the dual mandate? Some commentators have worried that establishing a specific numerical inflation objective might lead to an overemphasis on controlling inflation and not enough concern about stabilizing real economic activity. My proposal is, however, consistent with the dual mandate because it has the advantage of being less likely to be misinterpreted as a commitment to control inflation with a tight range over short horizons, since it only involves a consensus on the mandate-consistent inflation rate and an agreement not to change it without scientific justification. By so doing, this proposal should enhance the ability of monetary policy to stabilize fluctuations in economic activity, and therefore support the dual objectives provided to the Federal Reserve by congressional legislation. One lesson from the experience of foreign central banks with explicit inflation objectives is that such a goal is indeed consistent with a dual mandate for stable prices and maximum employment. Some of the central banks that have explicit inflation objectives have mandates that specifically include other objectives, such as output stabilization and financial stability. For example, the regulations governing the Norwegian central bank, the Norges Bank, specifically state that monetary policy should contribute to stable developments in output and employment. Similarly, the Reserve Bank of Australia aims at encouraging strong and sustainable economic growth while ensuring that consumer inflation is consistent with the explicit numerical objective over the long run. Even at central banks where the inflation objective appears to be the primary goal, policymakers do acknowledge that the stability of economic activity is also an important objective. For instance, Charles Goodhart, a former member of the Bank of England's Monetary Policy Committee, has emphasized that the MPC aims at stabilizing both inflation and real economic activity, and that its monetary policy strategy is quite similar to that of other central banks, such as the Federal Reserve. Moreover, as I noted earlier, the empirical evidence is consistent with his view. Central banks with explicit inflation objectives do not have worse outcomes for output growth and do not appear to be favoring inflation stabilization at the expense of output stabilization. So let me turn to the second concern that people sometimes raise. Should the inflation objective be stated as a specific numerical value rather than a range? Establishing a specific numerical value for the inflation objective is a crucial aspect of my proposal. As discussed in my recent speech with the whimsical title of Comfort Zones, Schmumfort Zones, and by the way, I gave it in Western Virginia, so I had to explain that with a couple of jokes. And I should tell you, there were ones that I took out because they were too outrageous. My son said, no, Dave, you can't do that. As discussed in this speech, what I said in that speech was that publishing a range of values for the inflation objective has a number of undesirable features. For example, when the price stability objective is formulated in terms of an acceptable range of inflation outcomes, the policy implications may be difficult to interpret and may make it harder for committee policymakers to decide an appropriate course of monetary policy. Describing inflation objectives in terms of a comfort zone could also lead to perverse expectation dynamics that leads to larger fluctuations in economic activity. Moreover, the uncertainty associated with a long-run inflation under a zone could affect the perceived long-term real interest rates based by households and firms through differential effects in the expectations of different agents. A pitfall that seems particularly plausible given the dispersion in professional forecasters' long-run expectations for U.S. inflation that I described earlier. Indeed, one important lesson from the international experience is that point objectives have proven more effective than ranges in anchoring inflation expectations. And even in cases where the inflation objective is formulated in terms of a band, emphasizing the midpoint of that band helps allay concerns that the central bank will only take aggressive policy actions at the edges of the band. In light of these considerations, many foreign central banks have taken steps to move away from an inflation objective that is expressed as a range and move toward an objective that is expressed as a single numerical value, as does my proposal here. And in fact, if you want to read some about this, take a look at the book that Adam and I worked on, which, by the way, I'm not touting anything, but we don't get any royalties from it. And in fact, funny story is we wrote this in our contract. We didn't get any royalties because we didn't want to have any conflicts of interest. But then I got an $80 check because in the contract we didn't talk about some kind of foreign deal, and I sent it back to the publisher. And they sent it back to me again. I sent it back to them again. And finally, we had this thing where I said, no, I can't take it. So I'm touting our book, but there's no financial gain in that regard, neither for Adam either. For example, the Bank of England initially announced an inflation objective in terms of a range from 1% to 4% for the retail price index, excluding mortgage payments, which is called RPIX. But this range was perceived as a band of indifference that implied the bank would be equally satisfied with inflation outcomes anywhere within the range. Perhaps partly as a result, inflation expectations and realized inflation tended to remain close to the top of this range. Thus, the objective subsequently was modified to a point target of 2.5% for RPIX inflation, where inflation above or below that value was viewed as being equally undesirable. We talked a lot about exactly this case study in our book. Inflation expectations converted quickly to this new rate in surveys of both households and professional forecasters. And the move was favorably received both by the public and by financial markets. In another instructive example, the ECB had initially emphasized the broad objective of keeping inflation below 2% over the medium term. But in May 2003, the ECB clarified that policy would be aimed at maintaining inflation below, but close to 2%. That clarification was welcomed by market participants and likely contributed to the firm anchoring of long-run inflation expectations. So now let me turn to another concern. Would this proposal be misinterpreted as establishing a goal for maximum employment? A central bank can determine the long-run average inflation rate, but, and this is very important, cannot choose the maximum sustainable level of employment, which is determined by the underlying structure of the real economy. Thus, one might worry whether providing longer horizon projections for output growth and employment, as well as inflation, might be mistakenly interpreted as establishing specific and ultimately infeasible goals for real economic activity. I do not believe that this potential pitfall poses a substantial risk. Because monetary policy determines the inflation rate in the long run, agreement on the mandate consistent rate among FOMC members can only lower uncertainty about future inflation. In contrast, differences in long-run projections for output growth and employment across FOMC participants are inevitable, as these factors are outside of the committee's control and inherently uncertain, given our understanding of economic fluctuations. And those of you who follow this literature know that there's a lot of uncertainty about things like Nehru and what potential GDP growth is going to be. And that will be reflected in people's assessments. The ongoing dispersion in long-run projections for output growth and unemployment that is a feature of my proposal would help underscore that these projections are assessments of potential output growth and the natural rate of unemployment, and should not, and again emphasize, not be viewed as numerical objectives chosen by the FOMC. So another concern, could the numerical inflation objective be modified if appropriate? One might be concerned about whether numerical inflation objectives could be subsequently adjusted for sound economic reasons. However, I would again draw on the experience from other central banks and point out that changing the technical specification of the inflation goal has been very well received elsewhere. For example, in late 2003, the inflation target of the Bank of England was switched from a 2.5% target for RPIX inflation to a 2% target for the CPI. Despite some concerns both from the public and the bank about the change, it appears to have been implemented with few problems. Similarly, as I mentioned earlier, the ECB also clarified its inflation objective, and this change was implemented smoothly. So another issue, would this proposal provide a sufficient degree of commitment to the nominal anchor? By stating its intention not to modify the mandate consistent inflation rate without a clear technical rationale, I believe the FOMC would provide a firm nominal anchor that would not differ much in practice from some alternative commitments to a specific numerical inflation objective. In explaining this view, I want to draw on some conversations with my son. So my son is in law school. I'm very pleased because for many of you in this generation, the sons are growing up slower than they used to. Then the daughters, of course, they're going to take over the world. So that's my daughter versus my son. But he finally is getting his act together, and he's in the second law of the law school at Cardozo Law School. He's very much enjoying it. And actually, he's intellectually engaged in it, so we talk about some of the concepts. And one of the concepts that we're going to talk about is very important in terms of this. But also, it's very important because I'm actually going to be using this concept in showing that I'm not just erudite in Yiddish, but also erudite in Latin. It's very important to show that I'm a classy guy. I did take 2 years of Latin in high school. I shouldn't tell you how, it wasn't my course, but anyway, but I did do that. So we'll talk about this concept in just a second. So, in this instance, the relevant legal term is stare decisis. So I don't know if I have any lawyers here, but you'll be very familiar with it. And what that means is to stand by things undecided. And this concept plays a crucial role in the functioning of our legal system. When the Supreme Court makes a decision in any given case, the reasoning behind the decision serves as a precedent that guides all subsequent legal considerations, except for particular circumstances in which the Supreme Court finds compelling reasons for modifying or overturning a prior decision. The approach that I recommended here would operate in a roughly similar way. Because the consensus on the mandate consistent inflation rate would be very transparent, the FOMC would not be inclined to modify that consensus value except for sound economic reasons. Hence, this proposal would be sufficient to provide a firm anchor for long-run inflation expectations. So let me conclude. While the recent enhancements of the Federal Reserve's communication strategy have been beneficial, I believe that the science of monetary policy indicates the FOMC needs to go even further. Thus, I have suggested that the FOMC should lengthen the horizons of its projections. Second, reach a consensus on a specific numerical value for the mandate consistent inflation rate. And third, indicate that this consensus value would be modified only for good scientific reasons. I have argued that moving in this direction would improve economic outcomes by anchoring inflation expectations more firmly while allowing sufficient flexibility to ensure that monetary policy would continue to be fully consistent with a dual mandate of price stability and maximum sustainable employment. Of course, once I return to academia at the end of next month, I will no longer be participating in any official consideration of these issues. However, I hope the views that I have expressed today will be useful in contributing to the continuing evolution of the Federal Reserve's communication strategy. Thank you very much.